Hello, everyone, and welcome back to the all-new Blueprint Strategy course, and welcome back to Module 4, Market Timing, and welcome back to Part 2 of this module, which is going to be focused around practical applications. As I teased already last time, we're now going to spend some time together to put all the puzzle pieces together by looking at the separate markets, and as we can cluster them into different categories, and what these categories have in common, and what may be unique to those market categories as we analyze them. So we're going to start with equity indices as a category. And within the equity indices, you're going to have the Dow Jones, you're going to have the Nasdaq, as well as the S&P. You may have other equity indices that fall within that group, like the Nikkei, like the German DAX, or the US Russell. But we're going to focus around the three most important ones, which is Dow Jones, Nasdaq, and S&P. After that, we're going to talk about precious metals. In that category, you're going to have gold, silver, as well as palladium. You may have platinum and copper that fall into that category as well, but again, they're less important. So what I want to do is I want to cover the primary, the most important markets that should also be most of what you look at. And once you master those, then you can branch out into other alternative markets, additional markets, like then maybe look at copper, or maybe look at platinum, or maybe look at lean hogs or wheat or whatever it may be, right? So without much further ado, let's just get straight into our equity indices. And what we're going to do is we're going to potentially look at our blueprint cheat sheet. You can always look to also on your own maintain this, right? But I'm also going to write down now as we look at equity indices, right? So we've talked about our 8 market timing rules. 7 and 8 of them are additional rules, and then we may have asset specific rules, right? And so there may be a rule 9 on equity indices, which are going to be .d coverage that is specific to equity indices, right? And so when I have an asset specific rule here, what we're then going to write down here as additional notes, you could do either or, right? As you would write down into additional notes here, then as we look at the Nasdaq or the Dow Jones, right? You would look at what are some additional notes. I need to look at the .d chart, right? So for example, and so I'm going to spend less time here because it would just mean I'm going to duplicate work in terms of whatever I write down here, write it down again within that cheat sheet. But what you want to do is you want to update that cheat sheet and write down as many notes as possible, because even a lot of things that I may not be writing down that you want to write down on your own, right? As an additional step for you just to remember a few things. And then as you practice this many times, the less notes you may need, right? So there you see only very little notes, but in the beginning you may need a lot more notes even that I'm writing down here. So this is really something that you have to work on yourself. Write down everything, and then as you go along, as you practice, as this becomes second nature to what you do, then you can remove some of the things and make it more clean, and really just have some things standing there that you need to pay attention on. Okay, so Now, starting with the Dow Jones, and the Dow Jones, you can see we already worked on within our weekly income worksheet. And so that's also going to be part of your business, is not just putting in new supply and demand zones and doing the analysis from scratch, but also updating charts that you've already done, right? That you've already looked at. So that may be a good example here on, because we've done this already, that may be a good example on, okay, let's just update and see what happened since we last talked about this. So since we last talked about this, this was our supply on the higher time frame. We had demand on the higher time frame. This was our location. And we can see that there has not been new demand that was formed. So this is still our first demand. And there has not been new supply that has formed. So this is still our first supply. So our location doesn't change. You can see maybe we started doing this like 2-3 weeks ago. And weekly analysis is so powerful. Weekly income is so powerful because once we've done it, we only very rarely need to update our charts. Most likely what we need to do is we need to update it on the lower time frame, but we'll see about that. In terms of the trend condition, what we had talked about is, okay, this is maybe a sideways trend or an anticipatory uptrend, or even an uptrend with 2 higher lows if we don't count this. We looked at the inverse head and shoulders here as well, with the right leg here and the neckline right there. And as we can see, this is playing out perfectly. So at this stage, this is for sure an uptrend. We created a new high, even we broke this high and we broke this high. So we created a new high and we've got 2 higher lows and we've got an inverse head and shoulders. And so at worst, now an anticipatory uptrend. At best, it is an uptrend. I would count this as an uptrend, right? I would count this as an uptrend. So we are within an uptrending condition. What do we want to do? We want to buy. Where do we want to buy? We want to buy low or very, very low. So where does our low start? Our low starts here. And down there would be our very low. And so from the 34,000 mark, I want to look to short. And if we go down to 33,400, we even have higher time frame coverage. But already if we go to 34,000, we are already going to be pretty low. Now, we still have our horizontal right there at the 34,000, which was our marker for, well, we look below to find demand zones. And this was our demand zone that we found that met all of our rules in terms of departure, base, freshness, originality, flip, level on top of level, higher time frame coverage, and so on and so forth. So now we may have new demand zones that have been created in the process that are below this line. So I need to check that. How am I going to check that? Well, I'm going to look at, are there any levels from 34,000 down? And here I have a massive gap up. Now, if you see a gap up, this implies a large explosive candle, right? A gap up always, if it's a large gap up, it has to be at least decisive. If it's a small gap up, then it's a decisive candle. If it's a large gap up, then it's an explosive candle, because instead of having a gap there, I could just say, well, if I had to color this if I had to put a candle here and I had to color this candle, then this would be a green candle, right? And so if I had to replace the gap with a candle, then it would be a green candle. In this case, you can see now it's an explosive green candle that could be my leg out. So if this is my leg out, then where's my base? Well, I have a basing candle right there. Where's my leg in? Well, maybe this green candle or this red candle is my leg in, depending on whether I'm going to say drop base rally or rally base rally. In this case, I like the rally base rally approach a lot better. So in this case, we would have this as a leg out, or even this as a leg out, right? Either or. And then we would have this as a leg in. And so we would have 1, 2, 3 candles in the base. Now notice how these 3 candles here, they may not all be indecisive, but they are small in comparison to the surrounding candles. And I can argue that these would be just the basing candles where price went sideways and then it went up and it continued its rally. So now I'm going to put my proximal at the highest base of the basing candles, and I'm going to put my distal at the lowest wick of the basing candles, including the leg in. In this case, the leg in is higher than the lowest base, the lowest wick of the base. So our level now looks like this. In terms of our sets of rules now, we have to update all of this, right? So now we talked about departure. Departure is quality, yes or no? Yes, otherwise we wouldn't have picked it, right? It's an explosive candle. We replace the gap with a large green candle. And so this makes a large green candle. This is a large leg out. It has follow through. And so departure is definitely explosive. It's very good. How about the base? Well, we've got 3 candles in the base. So the base is fine. Now my additional rule to further pinpoint the base is we use the first candle that's following the leg out. So if this is our leg out, we use the first candle, and now we can narrow down our base, right? So we were here before, and it really doesn't make sense to have a proximal here, to have an entry here also, right? Because if we had an entry here, we'd be in the middle of the gap. And so usually what happens with gaps is they get filled. And so if I use my own rule, if you use my own rule of, okay, use the first indecisive candle within the base that follows then the large move out, and use that as your benchmark here. You put your proximal right there. So I've got my proximal, I've got my distal. This may be a level. Base is perfect. What about freshness? Is it still fresh? Now remove these lines. Is it still fresh? Has price ever come back and touched this area? It has not. So rule 3, it's still fresh. Yes. What about originality? Is it original? It's a rally, base rally. If we look to the left, what do I find? Well, I find mostly wicks to the upside and maybe supply even, right? So I had some supply right there. Rally base drop. So all I can find is red candles and or wicks, top wicks. So there's supply or resistance on the other side. Therefore, there's demand been created in an area where we had supply before. So this has to be an original level, right? It would only be non-original if there was demand to the other side, but there's no demand, there's supply or resistance. So it's an original level, and it could even be a flip level, right? Because in that area of supply, so we had supply here, rally base drop, and in that area of supply, we now create a rally base rally. So this is even a flip. It's original and it's a flip. Do we have a level on top of level? Well, we have our prior level from before down here. Now, is that a level on top of level? Yes, it would be in this case, because the white space in between is equals or smaller than either of the two levels. So in this case, our lower level is just very large. So the white space here, or the black space here, the empty space in between, is smaller than this one, right? So yes, I have a level on top of level. So what I would do in this case is, as per the rules, it would be, okay, trade the lower level, okay? Set the lower level, maybe on the wider version. And then, so let's do that together, right? Let's do that together. We're not yet setting the trade, right? We're just speaking about the rules so far. So yes, it's a level on top of level. Now, higher time frame coverage. Well, let's check higher time frame coverage. So 33,700, 33,700, I'm right there. Okay, I'm not within the 33,400, I'm just within low. Okay, so this one to 33,400, the distal may be touching the preferred here, but it's not covered, right? It's not covered. The lower one at 3,300, it starts here. So that would be within the higher time frame. So this one is covered right there. This one is just above, it wouldn't be covered. So if we were to draw it in, just to visualize that for you, the upper level is kind of situated right here on the higher time frame, right? That's our lower time frame. So that's our upper level. And then the lower level is kind of situated right here in terms of the higher time frame. So we've got two areas. Here we've got the coverage of the higher time frame. Here I don't. So here I don't. Here I have the coverage. Okay, so level on top of level. Now the question is, if do we have higher time frame coverage? I would say yes, but only the lower level, right? Only the lower level. Now, let's look at our additional rules. Profit margin and arrival. Profit margin we base on our first level, and our first level in terms of the risk to reward, that price had traveled away from the zone, measured based on proximal to distal. So what we're checking is, how far has price traveled away from the zone, measured from proximal to distal. So 1, 2, 3. So it's more than a 3 to 1 to 3. It's bigger than a 1 to 3, so it meets the profit margin rule. And does it meet the rival rule? Well, we don't know yet, because price hasn't arrived yet within our zone, right? Price isn't there yet, so we can't look at the rival. Rival is something we can only look at once price is close by. So we have to skip the rival part, but we can say that all of our rules are ticked. We can say that all of our rules are ticked. So now what else is there gonna be? Well, we have to check the fundamentals still if we want to buy, and we have to check the additional rule for our lower time frames on the equity indices .D coverage. So this is how we're going to do it. I'm going to copy this, and I'm going to paste a new window. And here I'm going to remove all the drawing objects. I'm going to remove the link, important, remove the link. And now I'm going to call this add ym equals 107 xn. That's the normal chart, right? Now I'm going to call this .d. And what this will do, it will, you will see there's a lot more gaps here. It will now allow us to look at the regular trading hours only. Okay. So now we only look at the regular trading hours, at the Wall Street trading hours. Those are the trading hours we see the most volume. And therefore, these are the most important candles to look at. So again, as we go into the lower time frame, we want to be more scientific, we want to be more accurate. We want to align our levels with the institutional levels. So if, for example, let's say I saw a level right here, then this wouldn't be an institutional level because it's based within a gap here on the .D chart. So that gap would be called Globex, and Globex is not something that we want to trade, right? So we want to trade institutional levels. How can we ensure that institutions created that level? Well, when are institutions most active? During the regular trading hours, when the US Wall Street opens. So here we ensure we only see levels that have been created during those hours. So what I now see is, well, 33,709. I see that level right there. And that level right there is perfectly aligned. 33,448, 33,448. Here I'm perfectly aligned. Also have a gap up, which is very powerful with the .D. So I have .D coverage. What I wouldn't have wanted is to have a proximal here somewhere on 33.8, and then my proximal would be here on 33.8. In this case, I wouldn't be aligned with the .D because my proximal would be in the middle of nowhere here. So this is perfect, right? This is perfect. And now our lower level, 33.064. Here we could potentially even refine that a little bit. But we can see that 33.064 is kind of aligned here as well. So we have also .D coverage, and that .D coverage also with a gap up. So both levels are .D covered, which in this case is brilliant. And so we looked at the .D. as an additional rule, and we can say, yes, they are. Both levels are .D covered. Brilliant. So now all there's left to do, and something maybe we should have done anyways already, is also look at the fundamentals, right? So just to refresh your guys' memory, when we look at the Dow Jones, what are we going to do? Are we going to look at the COT? Well, we could look at the COT, but it's not so important. What's much more important are interest rates. So interest rates we're going to look at true seasonality, and we're going to have to look at our yearly roadmap as well. And for the true seasonality and for the yearly roadmap, I would even call this maybe even a 1. It's a primary tool here for our equity indices. Okay. What are the cycles that we're going to look at? 30 and 10-day cycles, trend following. October, November, December, we must buy. Yearly roadmap, look at the .D chart. Okay, perfect. So we've got everything covered. Now let's look at first of all, let's look at the valuation against the treasuries. And what we're seeing is that we're overvalued. Okay, so we're seeing that we're overvalued at the moment. So we wouldn't want to buy right now, right there. Anyways, we're in equilibrium, so it makes sense that maybe we're overvalued. Anyways, we don't want to buy. We only want to buy if price makes a correction. So when are we going to buy? Well, if price goes lower, but more specifically, when in terms of date is it most likely to get a rally? Let's look at the true seasonals here. And we already looked at this. So from the 29th of June, we get a very steep incline here, which is a very significant true seasonal period of time. So the 28th, from the 28th onwards, we want to buy. The only thing that can't happen at that point is, and this is something that we need to observe as we get closer to that date, is if we're going to be here, we can buy. Right? If we're going to be here, we can buy. As long as we're neutral, we can go and buy with the trend during those strong seasonal periods of time. As long as we're neutral. I will not buy if we're overvalued. I will just not buy, right? This tells me there's going to be a correction rather sooner than later. So I will just not buy. Here we're looking at 30. Let's look at the 10 as well. Also the 10 were overvalued. I will just not buy. So at least what I want to see is for the valuation to be neutral. And when we are neutral and in demand, we can look to buy, right? We can look to buy. Now let's also look at our yearly roadmap. Where can you find our yearly roadmap? You go to the classroom. You go to the stock investor. And then you look at the 2023 roadmap. And you can go all the way towards the end. There should be a summary, the good buy and sell points. Here. So 20th of August to 20th of September is a good buy. 1st June to mid-July is a bearish period. And to mid-July is bearish. So we can see that, right? So here we don't want to buy. However, from here to here, which is then kind of starting either here in August, but it may already start here. Here we can definitely look to buy. We're not going against our yearly roadmap. So what we don't want to happen is we don't want to go against our yearly roadmap. So far, the yearly roadmap has working out quite beautifully. We got January, February, March, April, super bullish, the blow up rally. Then June to mid-July was very bullish as well. We just got another rally in assets. And so now we maybe get the first kind of decline here. And after that, we should get a nice little rally all the way into September. So we can be bullish starting from mid-July, because mid-July is where this ends. So starting from mid-July to all the way until the end of September, specifically here, very powerful is going to be 20th of August to 20th of September. So this is our yearly roadmap. You want to align yourself with that, or at least have this neutral if your yearly seasonality is bullish, right? So here from the end of July, our yearly seasonality is bullish. Here from the end of July, we're also gonna be kind of bullish here as well, right? So here I have it aligned. I looked at the yearly roadmap. I looked at this. I can just follow our yearly. I can just follow the true seasonality here. And now we just have to agree on how we're going to set that trade, right? How are we going to set that trade? And this is where seasonality is going to be super powerful. And seasonality is going to allow us to kindly tweak our rules, right? So our default setting when we have a level on top of level is trade the lower level, set the lower level based on the wider version, which then would be here, based on the wider version and just have an entry here, a stop loss below, and just that's our default setting, right? However, and this is still true, this is still how I would do it. Now I would potentially here in this case not even go to the wider, just because it would make the level so large, and because anyways our .D coverage, if I use the wider, we're not going to be within .D coverage anymore. So I want to stay within .D coverage, which is 33,100. I'm not going to go higher than 33,100 because then I don't have my .D coverage anymore. So 33,100 is as high as I would go in terms of the entry here. I wouldn't necessarily go into the wider version because of that reason, and just because it would make the level just way too large. So for me, the option is either I trade the first one or the second one. What am I gonna base that on? I'm gonna base that on the true seasonals. So let's argue price is gonna come down rather quickly in the next few days, and price is gonna be here. Now we have, in this case, we have maybe a week left to position ourselves. What are we gonna do? Well, I'm gonna wait for maybe price dropping lower. However, if price is just gonna stay a step lower, and now we're gonna close in on the 28th, and we haven't even reached the first one, then the likelihood that now we're gonna go down there is very low. So I'm gonna set the first one with a stop loss there. So I'm gonna use the true seasonals as a roadmap for me now to identify which level I'm gonna set. The default setting as per the rules is always the lower, right? And we can be hopeful that price goes into the lower. We don't have to be scared that price is running away, because only from the 28th of June, usually price starts to run away. So we can be patient, and the closer we get to that date, the more aggressive we're going to be. So depending on where price is at that time, we're going to set either the lower or the higher, with the default setting being the lower. Okay, so using the true seasonals as a roadmap in terms of when is the best date for us to position ourselves in one of our levels that we have identified that both are very much high quality. Great. So we talked about the Dow Jones and we kind of just did an update there, right? We added a new level. It's definitely something we want to continue to observe now week after week and trade either one of those. Just add the 33% if I'm going to trade this one. And if I'm going to trade the lower one, that there I have my entry and my stop loss there as well. Now, I'm going to copy that over and we're going to do one from scratch. Let's do the Nasdaq. And on the Nasdaq, I also want to look at NQ equals 107 XM. If you cannot, it's fine, right? Use @NQ, but if you can use the custom symbols, then use the custom symbols here. So we're just going to start now with our higher time frame, and we're going to do location. So this is current price. Let's look at supply first. And I'm going to just use a horizontal here at that high to see, okay, where there may be some supply. There is a big, large red candle. So, and I have a indecisive candle right there and another large candle. So in this case, I'm going to have a drop-based drop supply. Where do I have demand? I have a first decisive candle right there. And I may have two basing candles, and then I have another decisive candle right there. So I may have a level right there. Now, that level, I may have some issues with. Why? Because this is a potential speed bump. Okay, so I've got a large leg up overall, a lot of green candles, and towards the end of that leg up, I've got two candles that may deceivingly look like basing candles, even though they may not be, because they're green, they have large bodies, and they look like they're towards the end of a rather larger move. So we can look at this, but we have to understand that this may be a speed bump. So let's just say this is a speed bump. Okay, let's do safety first. Then the next decisive explosive candle, well, we only need decisive, but explosive is of course always better. They come in down here. So, and then I may have a large base here, lots of basing candles here, right here. And then I have another leg in there. So if I'm going to look at the chart like this, then you can see it much better. And that's also what I like to do in terms of charts. I like to squeeze them. If I squeeze them, then oftentimes you just see the imbalance much better. And here I potentially wouldn't have even seen this as a base, right? So okay. Now I'm going to go from distal to distal. $33 and $66. Okay, so I've got my equilibrium. I'm high, very high. I'm almost very high. So I'm high at the moment. I'm not even equilibrium. Low starts right there, and then I'm very low there. So remember, if we have strong uptrends, something that we can do is we can also buy within equilibrium. However, I would rather not. I would always rather buy within low and very low. But within strong trends, we can buy in equilibrium, right? So let's do trend, okay? Let's do trend. So we may get stuck at the location if we look at this for too long, right? We're like, what should we do? Well, we haven't even done a small percentage of the analysis just yet. So we just need to move through the analysis, and then hopefully put all the puzzle pieces together at the end, and then have a clearer picture on what we may want to do. The first thing I'm going to do here in terms of trend is I'm going to add a study called the zigzag in percents. And I may move lower in terms of the percentage points. Okay, so here I see a potential trend that's going to be formed, right? So what I can do is I can now remove this. This was kind of my help line, and just draw in the trend myself. And I'm gonna use my arrows to mark the pivots. This one may be a pivot, but I don't know yet where that's gonna be. Maybe we're gonna go higher, maybe we're gonna go down from here, I don't know. So, but what I do have for sure is I have a low, I have a higher low, I have another higher low. So even regardless of the highs, I have 2 consecutive higher lows. This is an uptrend. It has to be an uptrend, right? So for sure, we have an uptrending condition. There are no 2 opinions about this. This cannot even be a sideways trend, cannot be a downtrend. It can only be an uptrend, right? There are no 2 opinions about that. So quite easy. We have an uptrend. So we have a very strong uptrend. So we can potentially look to buy in equilibrium. So during strong trends, we are allowed to act in equilibrium. Okay, and as an act, buy or sell. In this case, it's an uptrend. So anyways, I only want to buy. I don't want to sell. But if it was a downtrend, then I could also look to sell in equilibrium. So during strong trends, we're allowed to act in equilibrium. It's a very strong trend, lots of impulse. And so therefore, I could technically look to buy in the lower time frame now. That's the next step. In the lower time frame, as we start at equilibrium. So what I'm going to do is I'm now going to put a couple of lines here. So 14,900. This is where my equilibrium starts. Now, 13,800 is where my low starts. And so ideally, I'm going to be below that, but I may have to look at above that line within that equilibrium. Whereas the end, 12,800, just to give myself kind of a window of opportunity to say, okay, I'm going to go till here and not lower. Right here, 12,800, 12,800. Okay, so this is my window of opportunity now. What are my fundamentals? Were overvalued. Of course, we're at high, very high, so makes sense that we're overvalued here as well. Maybe expecting a little bit of a correction. When's the best time to buy? From the 28th year as well, just like with the Dow. From the 28th onwards, oh my God, there's just a significant steep move up higher. No brainer to be buying here. And so that's also in line with the yearly roadmap. We checked that already. So the only bad thing at the moment is we're overvalued. So we need that to go down to the 50 percentile range. And it may, if we get a correction, If not, I'm also not going to buy, right? If we're going to stay up there, I'm also not going to buy. It's just a difficult market environment. Definitely, I can't buy anyways because at the moment, because we're at high and very high. So our rules will not allow us to buy. And now, since we figured that out, now all there's left to do is let's look for levels. Right, let's look for levels. So I'm going to copy that. Over to my Nasdaq window, so I don't have to write everything down all over again. And I'm going to remove the below. We know this now, right? We know this now, so we can remove this and removing all of that. Where do I have a nice explosive green candle? Where would you say? I would say the first kind of explosive candle that really intrigues me is this one. Though I'd already find something here, maybe a rally-based rally here. However, this is just all very messy. What I mean by messy is there's just gaps and gaps and gaps and gaps. So many gaps, just messy. And this is equilibrium. So if it's equilibrium and it's messy, I'm staying away from it. Here I've got equilibrium, a departure, but it's not messy. It's very clear. It's the nicest leg out I can find within that entire time frame. And so I see this here, and then I see another maybe decisive candle. Then I have a gap. And so that gap here again, if we were to put a candle in there, it would be a green candle right there. Let's just put that in. So we have a green candle there. So what I now can see is here I have also kind of a clear base too, right? With maybe a leg in, a base, and then a leg out. So what I can for sure say is that I may have a departure here somewhere, either here or here, maybe even just here. And I have a leg in here somewhere. So I have a rally, base, rally, with all of those candles here being part of the base. So I have, this is the highest base. This is the lowest wick of the base, including the leg in. So this is the highest base of the base, of the base in candles. And so this is my level. And my level, what I like about it is it's borderline low, right? It's borderline low. Now, what do I not like about it? I do not like about it, without even testing the rules now, that my proximal again is up here and I have a gap just below that proximal. But let's talk about this within the rules. So departure, I can say that for sure it's a yes, 100%. At the base, I have 1, 2, 3, 4 candles within the base. So it's within our 1 to 6 or 7 candles. So it's fine. Yes. However, what I don't like about the base here is that there's a gap just within that base. Well, let's use my base rule, which is I use the first candle, indecisive candle, that's then following the large leg out. So here, I would put my level like this. Okay, that makes it a bit better. However, I still have a gap from here to here. See. This is a gap. From here, where the candle closed, to here, where the next candle opened. So there's a large gap. I don't want my proximals to be within large gaps. I just usually don't want that, okay? And write this down if you want. I usually don't want my proximals within gaps, either at the gap fill area, or it can be part of a gap, but I don't want to lose too much space here. So I definitely wouldn't want to have my proximal here. If I again use my rule of use the first indecisive candle that's then following the large leg out, then at least we only have a small percentage of the gap here. But anyways, we're not done yet, right? We still, we can say base, yes, but gap may be concerning. So far, we're not setting anything yet. There may even be a level on top of level anyways. So I don't care yet. So I don't care yet too much about this. What about freshness? It is fresh because price has not come back to this area ever. So yes, it's fresh. What about originality and flip? Well, it's a level on top of level. If I look to the left here, what do I see? Rally base drop, drop base drop. I see supply, rally base drop. So I have a level that's been created within a level of supply. So A, that's original, and B, that's flip. A, that's original, and B, it's a flip. It's a flip because and by the way, it was a big pivot area as well, right? So we look at pivots here as well. So we had a pivot, we had resistance, we had supply, and even here we had supply, and price just cranked through that, and that's the origin of that. So it is a flip area, beautiful, beautiful flip area, and it is original. Now, do I have a level on top of level? Let's look below. Let's remove this. Let's remove this. And this we keep as our low marker. We look below, and there may be something here, right? And now when we look at level on top of level, what's our main rule about the level on top of level is, well, everything that looks like a level is a level. So here, I'm just going to eyeball what I believe is going to be that level. So I have a rally, base, rally. So I believe that to be the base. And now I may have too many candles in the base here. Do I care? No, I don't. Right? Why don't I care? Because I already tested my base rules here. Here I'm going lower. I'm just having additional coverage. So I don't care if, my level up here is, if my level down here don't meet any of those rules. I don't care because my upper one already did, right? My upper one already did. So because my upper one already did, when it comes to coverage, I don't care about all this stuff anymore. I'm just looking for coverage. That's what I do. So here I have clearly a rally, base, rally. So do I have a level on top of level? Yes. What about higher time frame coverage? Well, higher time frame starts at 13,400. So 13,400 is here. So my lower level is covered. However, my upper level is not. So lower level, yes. Additional rules, profit margin. I mean, just eyeballing how far has price traveled away from the zone, measured from proximal to distal. We have a 1 to 1, 1 to 2, 1 to 3, 1 to 4, 1 to 5, 1 to 6, 1 to 7. So yes, it's bigger than 1 to 3. Arrival we can't test yet because price needs to be closer to the zone for us to be testing arrival. And now the .D coverage, it's going to be interesting. Just create. So for the .D coverage, I'm going into this right here, and I'm going to put in here. What you can do is you can just change add NQ. Everything else stays the same. So add NQ.D equals 107xn. So now, where are my levels? The first one is 13,729. So from here to here roughly. And my second one is 13,468 to here roughly. So see how much coverage I have. The upper level is only covered up until from 13,650. So being at 13.8 or 13.7 really doesn't make sense. However, my lower level is fully covered, beautifully covered, and it's anyways a level on top of level. So in this case, that is the level that I want to focus on. Regardless of seasonality, regardless of whatever, this is the level I want to set, because here, this is way too small. With that gap here and everything, it's way too small. It becomes way too small at that gap fill area. I don't want to time this market within 100 points, right? We're no magicians. I want to give myself a little bit more space. So here I have a level on top of level. At the 33% rule, we're going to put our entry now on the wide. I'm going to remove this. I'm going to put my entry on the wider, what I perceive to be the wider version. That's right there. Oh God. So that's my level on the Nasdaq. .D coverage. Yes. Beautiful. Now, what is the problem with that? Who can guess what the problem with that is? The problem is that we only have 1 week left or so before we want to buy. And what is going to be very unlikely is that price is going to go down all the way until here before we then want to buy. So it looks like the Dow may be more likely, right? Already it's like, it seems to be closer to price. And so for the Nasdaq, it may be difficult looking at our sets of rules to position ourselves, but never say never. We're still going to have this on the radar. If it happens, great. If it doesn't happen, then we have the Dow, right? And that's why we look at 3 of our equity indices, and we just need to find one of them that's setting up. And then we can trade that one. What we don't want to do anyways is we don't want to trade the 3 of them all together, because they're all positively correlated. As they're positively correlated, we're just adding too much risk, right? We're just adding too much risk. It's buying the Nasdaq and buying the Dow. It's very similar. Buying the Nasdaq and buying the S&P is very similar. So what we don't want to do is we don't want to have too much risk on the table that is positively correlated. We want to be diversified in also our risk approach. And so we pick 1 or 2. 2 we can pick if we divide our risk size. And usually we would just pick one that's setting up the best. Lastly, we can look at the S&P. All right, let's look at the S&P. And here we can now be a little bit quicker. At ES equals 107xn. Oops. At ES equals 107xn. So current price, let's look at supply. And whether you look at supply or demand first, it really doesn't matter. Seems like we have supply here. Rally-based drop. Where do I have demand? All of this may be demand. It's a large demand area, but it is what it is. So we're high borderline equilibrium. Let's look at the trend condition. We've got 2 higher lows. We've got higher highs. Regardless of the higher highs, we've got 2 higher lows. So it is for sure an uptrend, and it is a very strong uptrend at that. Again, no two opinions about that. So I have a strong uptrend. It means that I can buy already within equilibrium. Let's put our help lines in. Okay, where does equilibrium start? At 4437. This is where 4437. This is where equilibrium starts. Where does low start? 4250. And then where does it end? At 4062. Right here. So I've got the start of my equilibrium. I've got the start of my low. And then ideally I buy here somewhere. I may even buy here somewhere if I have to. What about fundamentals? Also overvalued. Of course, we're high here, just like the other equity indices. When is the best time to buy in terms of the true seasonals? 28th of June. It's just the same true seasonal rally. Okay, so 28th of June seems to be a very beautiful hotspot for us to take some trades on. And all we need to find is some quality demand. So let's do that. Let's find quality demand. In this case, right, so if I'm going to look at the chart like this, then where do you see the first demand? Well, the first demand I would see is right there. That is the first demand. Now, again, we have a gap here. So what does the gap imply? The gap implies an imbalance, and it's a gap up, so it's a green candle. So I have a large green candle, and then all of this move seems to be originating from here, right? So let's take a look at this right there. Let's take a look at this. Beautiful. So departure, well, it's a very clear explosive leg out and follow through. So yes. What about base? I've got 1, 2, 3 candles in the base, rally, base, rally. Yes. What about my own rule in terms of the base? Well, use the first candle, indecisive candle, following the large leg out. That's the leg out. So that's the first candle. That's where I put my proximal already. So perfect. What may be the issue with that, again, is that all of this, my proximal, again, is within a gap. Okay, so I've got a gap here. So being mindful of that. Anyways, I haven't looked at level on top of level yet, but just being mindful as of now that within the base, I have a gap, okay, which is usually not something that I like. Is it original? Well, is it fresh? Yes, price has never been here before. Is it original? Let's look to the left. What do we have here at the left? Well, we have rally-based drop. So we have an area of demand at an area where we had supply previously. So yes, it's original. And at that, it's even a flip. It's a flip because we had supply here, and it's even a pivot area too, right? So it was a pivot area, large pivot area at that, and it was supply. And what did price do? Price just broke through that like a hot knife goes through butter. So this is not just original, it's also a flip. What about higher time frame coverage? Well, we already know that in terms of the higher time frame coverage, this is not, but we need to look at a level on top of level first, because this would be based inside of equilibrium, right? We know that we've got this help line and this help line. So this is inside equilibrium. So there cannot be higher time frame coverage. But let's look at rule 5, and which is level on top of level. Yes, there is maybe a rally-based rally here. So I could put the rally-based rally in like this. I could put it in like this. So if I use the 3 basing candles here, the red ones, I could put it in like this, and then I have a rally-based rally. And that rally-based rally would be inside of the low area already. So yes, I have a level on top of level. I have a rally-based rally. And the space in between, the black space or the empty space, is smaller than either of the two. And so I do have a level on top of level, higher time frame coverage. Let's see. 4 to 13. 4 to 13. Right here, I would have perfect higher time frame coverage. Well, it is, parts of it is within the higher time frame. So yes, I have higher time frame coverage, but again, only the level on top of level. Now you can see why level on top of level is so important. If I trade the first one, then I'm in equilibrium. I trade the level on top of level. I trade with higher time frame coverage. So already it looks similar to the Nasdaq that we just did. Profit margin is also given. Arrival we can't test yet. Now .D coverage, something that we need to test now. .D coverage. So my lower level that I would want to set for 250. For 240. Okay, so I'm kind of, well, my distal 4173 is, I've got the coverage on my distal, but on my proximal, I don't yet have that. So at 4228, I would have that. Okay, at 4228, I would now have the .D coverage as well. So what I can do is, this allows me to refine this a little bit to 4228, which will take me straight here. Okay, so 4228, 4228, I have .D coverage. Perfect. I have higher time frame coverage. Perfect. I am trading with the trend. Perfect. If price gets there prior to the true seasonals, perfect. So how would I set this now? That first one I don't care about. This one is the one. Entry. Stop loss. Here we go. That's our set. And so what needs to happen is with a correction, hopefully valuation will be a bit better for us, and we should be buying in and or around the 28th of June. And then if price comes down until then, fills us, then we can ride a big wave to the upside with that big true seasonality. All right, so now we looked at equity indices. We put all the puzzle pieces together. We found some beautiful set areas, and it seems like the Dow is the one that's most likely to be triggered because it's also the one that's close by, that's closest to its demand areas. However, all of them we now have on the radar, and all of them are worthy to trade. All right, that's everything there is about equity indices. You can see we didn't even look at the COT. We don't really care. We could have done this, but we don't really care as we look at all the other things that we already have access to. And now in the next one, we're going to look at our precious metals. Thanks again for watching. Happy and safe trading, and ciao.